Good morning. You're listening to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
Good morning. Welcome back to another edition of Insurance Matchmaking. Last week, if you tuned in last week, I talked about everyone's favorite subject, life insurance. We'll touch on that a little bit this week, but one of the things I brought up, because I talked about how life insurance could be used for long-term care. So I want to kind of address some of those issues that, as you've probably heard me say, I'm not a fan of traditional long-term care because it is a use it or lose it insurance, which is generally, hopefully, what we do with our homeowners and car insurance, too, is hopefully we pay the premium and don't have to use it, but it's there when we do. And that's kind of what happens with long-term care. But it is very expensive, especially if you waited until you were older, and you can be turned down for health reasons. So that's what I run into a lot with my Medicare clients is they'll ask me about it, and they're diabetic or they have other health issues, or they're round like me, as I say when I talk to the people, young people, say get your insurance now, life insurance now when you're young. Don't wait till you're old and round like me. The same goes with long-term care insurance. Sometimes you can get it through a employer-based program. I strongly encourage if that is available, go ahead and do that. It's like I tell people when they come ask me about dental and vision insurance, but they're on a group plan. I'm like, if you can keep the one that's on the group plan, keep it. I can't beat the rates. Payroll deductions, you're going to get a better rate. And a lot of times those things will come. You don't have to go through the health underwriting. I think it's kind of, they figure if you're able to show up for work, then you're probably in relatively good health. So they go ahead and approve you for the plan. Then you get it and you just continue to pay. And if you leave that employer, you can continue the insurance as long as you continue paying the premium. So that is one way to get long-term care insurance. Unfortunately, most people have not done that. And like I said, they come to me when they're getting ready for Medicare, and when they as we say, they get sticker shock once I tell them how much they're looking at if they're going to get it. Tyler Lamson with Beacon Legacy Group was here a couple of weeks ago and talked about how the average cost in a nursing home right now is about $140,000. Well, most people aren't making that kind of money when they're retiring. They maybe were when they were working, but once they're retiring, maybe they got Social Security and a small, some money coming from a 401k or IRA or a pension. But it's still not going to cover all of those costs. So you do need other things to go along with that. And that's kind of what I wanted to address today and I think I touched a little bit last week when I was talking about the life insurance, that you can get life insurance with a long-term care rider. That is one way to do it. And usually that's going to be a whole life plan. It could be an index universal life. There's just some different quirks between those two options, but I highly recommend, if you're looking at life insurance and you're over 50, is look for some permanent life, because term life, is going to be very expensive at your age then. And again, you're only going to get 20 or 30 years. And if you live past that insurance is gone. And then you're not going to be able to get anything that's going to help you in your retirement. So look at something that's permanent. Yes, it's going to cost it's going to cost you more. And that's what thing I think is a big misconception is you're going to spend more on it, but is it really costing you more? Because those permanent life plans once you get that plan, you've set that premium in place. And as long as you can continue to afford to pay that premium, then you've got that insurance and it is building cash value. And again, especially like usually more with the universal life plans, are you paying in you could have a decreasing death benefit because the insurance now is starting to pay, or the cash value that you've built up in that plan is starting to pay your insurance costs. So the balance of that plan could diminish, whereas whole life plans, you're usually you're either like on a guaranteed annual interest on it, or just the fact of they don't lose anything. And so usually you just continue to pay that premium. An index universal life plan is going to have a minimum premium. That's just to keep the insurance in force. It's not really going to build any value if you're paying that minimum. It's kind of like with a loan. If you're only paying that minimum payment, you never pay it off. With IUL, if all you're paying is the minimum payment, it's never going to gain much in value. So you do periodically want to add to it, or start increasing. Maybe you, and just for example, it's $50 a month, and in year 2 you say, I probably should be putting a little bit more in this and build it. So you start paying $60 a month. That's going to build some cash value. Anytime you add, it's just like, or if you want to pay off a loan, if you pay a little bit extra on the principal, then less interest gets applied. So it's kind of the reverse. If you put a little bit more in, you're going to get a little more interest on it. And those, like I said, those things can be used for long-term care. The other way, and I've mentioned on here, is what my wife and I have, is an annuity. And the great thing with an annuity, if you're and this is going to be the same thing with your life insurance, but if you're taking the money out for long-term care, it's not going to be taxed. So that's a biggie there. Of course, if you're using your long-term care insurance, that's not taxed either, but you spent that money. With an annuity or a life insurance plan, you own that plan. The cash value of that plan is yours, and you can give that money can go to a beneficiary when you pass. A lot of times that beneficiary is going to be your spouse, but you can have those secondary beneficiaries of your children or grandchildren that you want to leave a legacy to. So you can't do that with a long-term care policy, as I mentioned. It's use it or lose it. That's why I highly recommend that you do a life insurance or an annuity-based long-term care. The other thing is generally they'll have like a multiplier. Your guaranteed income on that annuity is going to be more if you're using it for long-term care. That's kind of, they build that into the package to make it a little more attractive for you. So I can't say it's an investment, but you are kind of investing in your future that way. I'm not an investment counselor. I can't say it's an investment vehicle. If you're putting money somewhere and it's growing, you get the picture. So that's why I try to recommend annuities for long-term care. And one of the companies I represent, they're very, I don't say lax is not the right term. I don't want to use the term liberal because that can have the wrong connotation too. But their simplified underwriting is more apt to be accepted. I mean, there are certain health conditions that they're going to say, oh, no, sorry, we can't cover you. But they're also can be forgiving on some things that you think you wouldn't get qualified for. Now, one of the things they will do is you'll have a phone interview and they'll do a memory test, and it can be kind of frustrating, but memory care is what we're wanting to avoid. They want to make sure that you don't maybe already have early onset Alzheimer's and dementia, because that's what the costs are going to be. So they're not going to take you if you got that, but just because you had a heart attack 5 years ago doesn't mean they're going to turn you down, or you've had cancer. A lot of those things are not knockouts if they're far enough in the past and you have recovered from them. So that's one of the things with the underwriting. The other thing is we do have plans that we call short-term plans. And they work a lot like a long-term care plan. And again, what they're designed for is to keep you in your home, not move to the nursing home. Because a common misconception is people think, oh, my Medicare covers home health. Yes, your Medicare covers home health. Home health in that definition is a nurse who comes out to the house, maybe changes a dressing because you had a surgery, but you're home, and they're going to take that and they're going to take your blood pressure and, do a kind of quick checkup. And they're there for maybe an hour if they're that long. And they're gone. They're not going to help you in and out of bed. They're not going to do your dishes. They're not going to just do menial tasks around the house to help you out. That's what we call a home health aide. Medicare does not cover that. Long-term care plans in some cases won't cover that. It depends on what services you're getting. So there's a couple different ways of plans that will help you for those things of staying in home. Some of them are what we call they are indemnity plans, and they're just going to pay you that amount. I mentioned that with the life insurance last week. Is your doctor says you can't do it depends on the plan, 2 or 3 of the 6 ADLs, activities of daily living. If you're not able to perform those tasks, you're not able to get yourself out of bed, you're not able to cook anymore, you can't dress yourself, those kind of things like that you need help with, that's where these home health aides come in. Now, a lot of your long-term care plans and even some of the short-term care plans are only going to pay out if you're using licensed care. And unfortunately, usually what you're hoping for is maybe you have an adult child who, usually the statistics say typically it is the eldest daughter. And a lot of time, and there may be they might be an empty nester now, but they're working. And a lot of times they end up quit working to take care of mom or dad, but they're not licensed care. So a lot of the plans aren't going to pay them, whereas some of the plans that are just indemnity, they're going to pay you a lump sum if you are partially disabled now and can't do those activities of daily living, and you use that money how you choose. You can hire that family member and pay them and make up for the income they're losing because they quit their job to keep you out of the nursing home, or you move in with that adult child and they're staying home now because they can't leave you home alone. You might fall. You could be having, some dementia. And that's the other thing. The memory care, the diminished mental capacity, that's an instant trigger for these type of plans so that you would qualify because of memory care. So you may not be able to be left alone because you may, especially you've moved in with your child. And yes, when you came to visit, you were familiar with the neighborhood and such because you had all your mental faculties. But now that you're with diminished mental recall, you're not in your home. And even if you're in your permanent home, for whatever reason, people they start thinking they're in the neighborhood they grew up in. And so everything, they walk 100 yards from their house and they can't remember how to get back. So those are some concerns that, a lot of people have and want to be able to make sure they can take care, or you can have somebody take care of you, or make sure that you're taking care of your loved one. The other thing is maybe you do move in with that adult child and they just need somebody to come and spend a few hours with you during the day while they're still working, so that when they get home, it's kind of like we do with the kids. You have a babysitter that watches them from 5 to 7 till you get home from work, or from 5 to 7, from 3 to 6 until you get home from work. So sometimes you do the same things with your adult, your parents that are diminished. These plans can pay. So like I said, depending on how they work, some of them you have to use licensed care, and sometimes that licensed care can still be a family member if they've gone ahead and gone through the training and got their certified nursing assistant certification. Sometimes that's all you need, or you coordinate with some of these programs, the Mom and Home, Visiting Angels, trying to think of some of the names. I'm not endorsing any of them. I'm just trying to come up with the names of plans that may be useful. I said Visiting Angels. Silver Angels is another one here locally in Tennessee. So those are some ways to do that. I'm going to get into kind of the nuts and bolts of the short-term care plans after the break. We're up on that. We're bumping up against that commercial break, but we'll be right back.
Hi, this is Emily Gibson, your local Twin Lakes security consultant. With freezing temperatures hitting the upper Cumberland, it's important to keep an eye on your home's water pipes to avoid costly damage. Twin Lakes Security offers smart home solutions like temperature alerts, water sensors, and alerts straight to your phone, giving you peace of mind all winter long. Give me a call at 931-528-2005 or visit twinlakes.net.
Twin Lakes Security, TN-CERT C-0026.
Need a little help with home repairs? The Habitat for Humanity Critical Repair Program is here to lend a hand. We're accepting applications now through February 14th for non-emergency repairs like plumbing, roofing, and more. Visit uchabitat.org and click the Critical Repairs Program tab to apply, or stop by our office at 1546 East Spring Street, Suite B. Don't wait. Applications must be postmarked by February 14th. Habitat for Humanity, helping you make your home a better place. Equal opportunity provider. Discrimination is prohibited by federal law.
And now, back to Insurance Matchmaking with Matt Libby Insurance.
All right, welcome back. Before the break there, I was talking about the short-term care plans, kind of some of the situations you may be utilizing that plan. As I said, I kind of get into the nuts and bolts of it. They're not very expensive, and I say, they're relatively inexpensive. They're nowhere near the cost of what you'd be paying for a long-term care plan. And even if you have a long-term care plan, you might want to think about a short-term care plan, because a lot of times the long-term care plan is not going to kick in for 90 days or 6 months, depending on what the exclusion period was on the plan you got, because they figure, well, you can spend a little bit on your care to make sure it's going to be something semi-permanent, and then they start covering. So sometimes a short-term care can start working immediately, but you also, just like with a disability plan, you can say, well, I don't need it to start, in the 30 days or 90 days. Depending how you do it. Of course, anytime you delay the start of something like that, you'll get a little bit, it'll lower the premium, because you're less apt to use it, because, again, it could be a matter of the disability that you're having could be temporary because you just recently had a surgery, and so the trigger would start that you can't do the activities of daily living, but once you've recovered from the surgery, you can. And so sometimes people will just delay that. They're just going through that normal, 6-week recovery period, and they wouldn't be drawing upon those services. The other thing is, with those plans, they are short. They're shorter term. They work like long-term care, but and that's why they can't use the term long-term care by definition, because they basically, the coverage is limited to a year. And actually, it's not exactly a year. Some of them it's 360 or 365 days. And the reason why I say that's not a year is you may not need the services every day. So if you have services for 365 days, but you're only using for 2 or 3 days a week, you'll still be able to claim on against that policy for year 2 and year 3 because you hadn't used up your days. Some of them they'll only pay for a home health aid. Sometimes they'll break it down that one will pay, $50 a day towards a home health aid, or, and again, it depends on the limits you pick, because they do, they have kind of, as we say, an a la carte menu when you're picking out the plan, that you want it to cover $50 a day, you want it to cover $100 a day. However, you're setting that up for that home health aid, or if it's fixed as an indemnity of if you qualify for the activities of daily living or the memory care trigger, the money just comes to you or your spouse or family member who is going to manage that care, and then they use that money to pay for your care. So that's one of the things, and like I said, it's less expensive than long-term care. The other thing that's unique about short-term care plans, and I've got at least 3 different carriers that offer these type of plans, and they all kind of do the same thing, is they'll give you a rebate on your prescriptions, because generally us people, we're United States, we take more prescriptions than any other country in the world. The way these plans work is they'll pay you a rebate on your prescriptions. You have to send in your receipts, and you can, and depending on the plan, some of them want you to send it all at one time in a year. Other ones, it doesn't matter. You can send one, a set of receipts in every week, and then they'll cut a check for whatever that amount is. The neat thing on that is the way they do it. If you're taking several prescriptions, your rebate can pretty much cover most or all of the premium of the plan you get. So, and I don't know if I've seen it, but they are limited. It's like it depends on the plan, but $100, $200, or $300 in the year that they'll pay on the rebate, but that covers quite a bit of premium. So that's one of the ways those short-term care plans can work and help you protect yourself against those where you might have to go stay in the nursing home or move to the nursing home when you're not ready to do that. And so you can insure against that. And again, if you're taking prescriptions, send in those receipts and get a rebate on that premium. So it's not going to won't cost you necessarily the full cost of that plan. So that's something to look at. But they'll, like I said, they'll pay for a home health aid. They may just pay you for your straight out the income. And some of them will have a hospitalization rider on them. And one of the neat things on that, a few of these that I sold to clients a few years ago were, the reason I did it was because of the hospital confinement benefit. If you have a Medicare Advantage, you generally, and I'm just going to generalize it, not all of the same, but you generally are going to have about a $300 per day copay for the day in the, a day in the hospital. And that usually can range from 4 days to 7 days. In fact, I've even seen some plans that have gone all the way up to 10 days that you would pay the copay if you're in. But after that Medicare Advantage plan is going to pay for the 100% of your costs. Well, some people, but you do the plans I have for that, those hospital indemnity plans that reimburse for that hospital stay, they're and as we say, health underwritten. You have to qualify health-wise for them, and sometimes certain health conditions would preclude you from having that, especially something like a recent heart attack or cancer diagnosis, or even being currently treated for cancer. Most hospital indemnity plans are just going to flat out turn you down for that. The neat thing with these short-term care plans, depending on your age, that some of them are limited, but you have to be a certain age or they're not going to give you the guaranteed issue option. And what happens when the guaranteed issue is, it doesn't matter what your health is, you can get the plan. The downside is, yes, there is a catch. And I want to say it's a catch, but there is a limitation. And most of the time it's 6 months. Some plans can be a year, but maybe they would reimburse for a hospitalization, but they're not going to reimburse in that trial period, but that elimination period, if it's for the pre-existing condition that would have got you turned down for another plan. For instance, I use the diabetes one. To say you're diabetic, this plan over here would turn you down just because you're diabetic. This plan here will say, no, we'll take you, but if you're admitted to the hospital anytime in that 6 months and it's related to your diabetes, then they're not going to cover it. But after that waiting period, they will. So if most people who are diabetic are, say, relatively healthy. It's kind of how I rate myself. Yes, I'm taking medications for type 2 diabetes. That would prevent me from getting many plans, many life insurance plans or hospital indemnity plan may turn me down for that. So these plans, that's how they'll work, is you can add that rider, as we call them, to cover the hospital admittance. And that helps you, especially if you have a Medicare Advantage, helps you negate some of those extra costs. And those benefits usually will reset. Now, the short-term care, once you start using those benefits, they're going to run out. Like I said, you're going to have 360 or 365 days of that care. The hospital confinement portion is usually limited to so many days per year. So most of those plans will reset. It's not a lifetime thing. Oh, you were in the hospital for 6 days this year. You don't have that benefit anymore, but thank you. Please keep paying your premium. So usually that's one of the benefits, and that's the way hospital indemnity plans work also, is you're limited to so many days per year, but they'll reset. Most of the time, those plans usually reset on your anniversary date. So if you got it in June, it would go to June of the next year and it reset. And some of them are calendar years. So if you got the plan in September, hey, you get a whole new set of benefits starting in January. And then from then on, it'll just every year in January is when your benefits reset. The other neat thing is, again, most of these plans, and not all of them, but most of these plans, a hospital indemnity plan will, but some of the short-term care plans do increase as you age because you're more apt to use it. But it's usually an age band. So like every 5 years or every 10 years, you'll have a slight increase to your premium, but they're not extreme. But as again, I've talked about, I don't care that much for traditional long-term care plans. They like to increase their rates, and they could increase them every year. And sometimes, and unfortunately, again, that use it or lose it, or they get to the point of, I just can't pay this anymore. And sometimes you have to let the plan go because you just can't pay it anymore. And you don't get anything back from what you paid into that for 10, 15, 20 years. If you have a whole life plan, you can surrender it and get the cash out. So you do have some money there that would come back to you. So that's, again, one of those reasons why you can do annuity. Maybe you got an annuity for long-term care, but you just decided, I want to start drawing some income off of that. You can start drawing a monthly distribution off of it. Again, of course, once you hit 70, you're going to have required minimum distributions if it is a qualified fund like an IRA or a 401k. So that will diminish some of your long-term care benefits. But you still own it. You still have the cash there. If something happens, you pass away, and you haven't exhausted the cash value of the plan, there's still something there that will go to your heirs. So let's talk about that. One thing I realized I wanted to touch on, and I'm about to run out of time here, is maybe you've heard the phrase having lazy money, or sometimes if you're a client, maybe I've asked you, do you have lazy money? And that's money that either, I hope it's not just sitting around the house, but maybe it's in a bank account. Maybe it's sitting in your checking account or a savings account that's paying nothing or next to nothing in interest. I'd like to talk to you about a MYGA, a multi-year guaranteed annuity. Most of those plans, you can start as low as $5,000 and put that money in. Guaranteed you're not going to lose any of your principal. And it can gain interest in, maybe you have a CD. Usually the interest rates are usually a little bit better on a MYGA than a CD. And also CDs, you're going to have interest penalties if you cash it out, whereas the annuities will usually let you take 10% per year out and without any penalty. So it's not totally locked up. And you can do them for 3 years, 5 years, 7 years, just kind of depending on, how comfortable you are of basically not having access to the money. Again, you can always withdraw the money, but you will have interest penalties, so you could lose a little bit in the interest penalties if you cash out early. But they generally guarantee an interest rate, and that's what you're going to get at the end of the 3, 4, 5, or 7 years. So, like I said, I'm getting close to running out of time. Remember, please go to insurancematchmaking.com. We have a comment form there. You can request assistance from our office. You can suggest a guest or ask a question for me to answer on the show. And that also links to my regular business page at mattlibbyinsurance.com. And want to schedule an appointment, give our office a call or go online. We've got links there to a calendar that you can go ahead and book a time to come in the office and talk about what I've talked about today, and we'll see if we can help you with that. Again, there's no charge for a consultation at our office, so give us a call, come in, and we'll look at your options and see if we can't find a plan that fits you. Again, remember, at Matt Libby Insurance, we can cover you from head to toe, and it doesn't have to cost you an arm and a leg. Till next week, Insurance Matchmaking, and we'll talk next Saturday.
You've been listening to Insurance Matchmaking with Matt Libby, your path to health, life, and Medicare coverage with Matt Libby Insurance.